Welcome, everybody, to our Straddles and Strangles webcast. I'm Connie Hill. I'm here each and every Monday to talk about just these two strategies. Now, we know that Greeks play an important role in what happens with an option, and today we're going to be focusing on implied volatility. Hopefully, give you a better understanding of how that works as it relates to these two strategies. Now, I am joined in the chat by Ben Watson, fellow coach, good friend, great veteran of the markets. He's here to help me field questions as they come in. I'll be keeping my eye on the chat, so as you have those questions, type them in. Ben will catch some of those things that maybe I can't quite get to, so appreciate his assistance here today. Now, I hope you're following us coaches on X. I'm Connie Hill, CS. Ben is Ben Watson, CS, and we'll post educational content, things that we notice about the market during the day. We'll post about that because we think you might find some value in some of the information we might share with you. So follow us, it's free, it's easy to do. Let's go through our disclosures and get going with our agenda today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and educational purposes only. Don't consider a recommendation. We'll be using the Paper Money software application. It is the most robust version of Thinkorswim. It is an educational tool. It's not perfect, but it does simulate what's going on in the markets fairly well. There is one difference. Paper Money will not assign you early. In this class, we do some selling of options, and so that's something important to recognize, that Paper Money won't mimic that functionality. Past performance is no guarantee of future results. All right, we're going to take a quick look at the current market, not spend a ton of time there. Want to discuss a little bit about specifically straddles and strangles. We've got a lot of examples to look at here today. We've got 3 trades we need to follow up on, and I've got outlined, I don't know if we'll get to all 4 of them, but 4 different trades that are going to be new, and we'll explore implied volatility as we talk about these new positions. Let's head over, let's go take a look at current markets. And I'm just going to start us here on the VIX because I want you to note that, where do you think the VIX is? Do you think it's high or do you think it's low relative to, say, the rest of the year? Okay, this is a 1-year chart. We had that peak last April when we had the big market sell-off. So yeah, it raced up here, got as high as 60. It didn't really stay up there, and that is a really high number up there at 60. Really, what we can see the rest of the year is kind of the high points here is maybe the VIX getting up to, say, 28. Yeah, we had here recently some spikes above 28, but we're not low. The VIX is not low. Down at 13, 12, 11, that's really pretty low. So I would say it's still in an elevated range where we should expect a couple of things. 1, maybe some swift movements on different stocks. 2, options have a tendency to be more expensive than maybe they are when the VIX is lower. And then the other thing, and I've noticed this quite a bit lately, the spreads are wider. So you might have a stock that you're working with, you pull up the option chain on it, and you're looking at the spreads, and you're like, man, this is quite a bit wider than what I might normally expect. And that is because what's going on with the volatility in the overall market and what's getting priced into those options. Now, we'll just take a quick look. I want to see on the SPX if we are, well, we were pretty flat earlier. It looks like we're up 0.2% right now, so maybe just up a nudge. And NDX was up a little bit higher than that earlier. Let's see where it is now. Our NDX looks like, yeah, it gapped up. It's holding that gain. It's up about 0.36%, which is not a tremendous amount, but it's interesting that it bounced off this low here, and just it looks like it's trying to fight back up. So we'll have to watch it and see what happens. I would say it's still, if I extended this resistance, I extend that to the right, and I might even move it out a little bit here. Looks like it's still down below that diagonal resistance area there. So we'll be looking to see what it can do. Yeah, Mary Burns says, yeah, You're thinking that the VIX looks a little bit high. Absolutely. Wacky's letting us know the oil and bond market are really stable today. All right. Well, we weren't planning to go look there anyway, but that's good to know. As far as strategies, we're in a period of time there is not a lot of earnings going on. Now, I went out to the Market Watch, and I'll go back to this week, and we're really in a fairly light stage. And really what I'll do is I'll come in and I'll see what stocks are announcing earnings, because this can be an ideal time to do straddles and strangles. Straddle is where we buy the same strike price on the call and the put. We expect a big move, but we don't know which way it's going to go. And so we're going to stake a bullish trade and a bearish trade and expect one of them to be a decent winner. A straddle, so that's the straddle. A strangle is where we go out of the money rather than at the money. So we go a little bit further out of the money. And typically what that's going to do for us is it's going to lower our break-even number as far as what we're putting out into the trade. However, kind of spreads our break-even apart a little further, because it's got to go a little bit further because we've selected an option that's out of the money instead of the at the money. Okay, so we'll be looking at that in a little bit more depth here today. But if you go out and look, you're going to see there are not a lot of stocks announcing right now. We're kind of a couple of weeks out before we really start getting a lot of activity and a lot of reporting. Well, let's head over here. We are going to first take a look at, let's look at this one first. Levi. You might have some Levi's in your closet. This is a stock that has a tendency to move pretty big over earnings. And so that's one thing we really want to pay attention to, is if we want to trade something, say over a big announcement, it doesn't have to be earnings, but over a big announcement, if it has a history of moving big, then we might have an expectation that, yeah, maybe it will move big this time as well. Want to make sure all of you are have access to this ThinkScript, which is the market maker move. And I'm going to just go ahead and share that with those of you that are here live. Let me put it in the chat. Remember, anytime we share scripts, they're not guaranteed as to accuracy or timing. And it's interesting here on this market maker move. It started up higher today. The first time I looked at it this morning, it was about 9 something percent. In fact, maybe, yeah, 9.39 is what I have in my notes. And those of you that are listening to this on the recording, what I'm trying to do is I'm going to move it down here, so you can see the formula there. Really, you just need past the exclamation point, that being the first of those 9 characters. Grab those. They are tab sensitive. Those of you that maybe are a little bit newer to scripts, what you would do is you would take either the whole URL or just from the exclamation point over. So let me see if it'll let me grab that. No, it's going to grab the chart. And then just come up to your setup, say open shared item, go ahead and either type that in, or if you've got the copy paste and you want to paste it in, go ahead and just paste it in there. Hit preview, import, and then you've got that script. Now I call mine market maker move MMM on the chart. You don't necessarily have to call it that, but that's just what I call it. And really what it's doing is letting us know what is the expected move for this particular stock for whatever the event is. In this case, the stock has earnings, and they are going to announce tomorrow, the 7th, after the market closes. Okay, so we've got a couple days before something really happens with it. And then these yellow lines here represent this $1.42 move up and down. Right now it's at 7.29%. So that may vary a little bit on that. Let's see here, Iceberg. They will go up after Trump talks. LOL, who knows what they should really be at. I think you might be talking about something other than Levi, but maybe about oil or something, or the market in general. Could be. Yeah, it seems to be very dependent right now on uh, geopolitical news and what's going on. So that's really moving the markets right now for sure. All right. So on Levi, want to make sure that, it does make big moves. And so we're going to go back, we're going to examine. I'm going to go clear over here to the left to look at this earnings announcement. This would have been kind of equivalent of where they are right now. So they announced on the 7th of April last year. And it was after the market closed. And so this big candle here is the first day that the entire market reacted to their news. And this is quite a big long candlestick. The range here is $3.38. And this was when it was back at even say a $14 stock. Okay, so yeah, that was a tremendous move. And then the next day went the opposite direction. So gapped up here, fell as the day went on. And then the next day opened here pretty much where it closed, but then it ran. And so that's something we want to pay attention to. Gee, does it have big candlesticks? Does it have gaps to let us know if the stock moves? So yeah, during that earnings announcement, definitely moved a lot. Let's look at the one right after that. This one, we can see a nice gap here, right? Closed here, opened up the next morning, clear up here, ran up a little bit, even pulled back a little bit, but ended up keeping the gain again for that day. But then the next day looks like it's sold off. And over the next couple of weeks, it went back to where it was pre-earnings announcement. Sorry about that, guys. My throat just keeps getting junk in it. All right, next one. Nice big gap down. So yeah, this stock moves a lot or has recently over earnings. And previous earnings, this one was in January. So they announced here they didn't really gap down much. In fact, actually, I take that back. They gapped down, clear down here, and then rallied towards the end of the day as the day wore on and closed up a little bit above where they were prior to the announcement. And so sometimes stocks will continue to go in whatever direction they initially moved, and sometimes they don't. Sometimes, and we saw this on Levi, maybe it was just for one day it went that direction, right? We have it one day racing up and then pulling back down again. And then further along, then maybe it took off. So with these trades, straddles and strangles, they're very speculative in nature, meaning might not be one of your bread and butter strategies, might not be something that you want to do every single day or every week, but maybe just in certain circumstances, okay? And so that's why I want you to know they are speculative. We really don't know what they're going to say and how the market's going to react, okay? But we are expecting about a little bit over a 7-point move, and so we see it graphically displayed there. Okay, let's take a look. Let's go over to our trade tab. Let's go to our options. And I want to just close this up for a minute. We talk about implied volatility, right? Implied volatility here, since they're announcing this week, we're going to look at the April 10 expiration. We're going to follow it across. And it priced into the options is a lot of implied volatility. 104%. That's a pretty large number. Okay, it could be larger, but it is really a pretty large number. And then you'll notice just even going out 1 week, how much the implied volatility drops from 104 to 78, and then down to 67. And then as it goes out further to some of these different months, then it really is dropped down. Well, implied volatility has a tendency to ramp up prior to an earnings date. So if we go back to the chart here on Levi and we look what has happened here recently with our implied volatility, it looks like it was starting to run up a little bit here, but it was not a steep run up. Okay. We see it poke up here a little bit with the last couple of days of movement. But what would we expect once the news comes out? Once the news comes out, we're going to expect it to drop. See here last time they announced earnings, see how implied volatility had been high and it just plummeted. We call that a volatility crash. And what happens is that implied volatility that had been priced into the options all across the chain that comes collapsing and crushing out, which means usually those option prices, because of the implied volatility portion, it cuts way back. All right. And so you can see this kind of happened a little bit over the course of the day. All of it doesn't necessarily happen at that very first, opening bell. A lot of it does, but it can continue through the rest of the day. So that's one thing we want to know what to expect, because that helps us with our outcome. Now on Levi today, we are going to do a straddle, which means we're going to use the at the money strike price. This is a lower price stock. We don't have a ton of options available here because the price of the stock is fairly small. So if we come back here to our trade tab, we do have weeklies for this week. Then we have the April monthlies, and then a couple more weeklies. Rather than buying these really expensive ones, we're going to go out a week. We're going to go out here to April 17th. And one thing we'll notice is that the open interest here is pretty good. Here's my column of open interest on my big green mouse here. We can see, yeah, there's a lot of activity. Remember, volume is just today's activity. If we go over here on the put side, here's our open interest column here. Yeah, we do have some decent open interest. If we were to do a straddle here, or rather a strangle, would be going out of the money. And there's not a lot of choices when we're going out of the money. Yeah, we have a 19, 18, 17. We do have that. But you look at the deltas and just, the 19 is already at a 39 delta. The 18's at a 25 delta. And so it's like really far out there versus another stock that maybe has a lot of different strike prices closer to at the money. Maybe it's a higher price tag. And so we see maybe a little bit more flexibility than maybe what this one might be offering us. So we're going to do the at the money, which it keeps jumping around here, whether it's going to be the 19 or the 20. Right at this moment, it's the 20. So we're going to go with the 20. We're going to buy the put and we're going to buy the call. And I'm just going to hold down my control key while I click on the ask price of the put. And then I'm going to keep that held down and we're going to buy the call. And you can see the put's quite a bit more expensive because it is 50 some odd cents in the money versus being out of the money. Okay, so the total debit on this trade is $1.88. Now, many times it's interesting to compare that to the expected move for the trade. So if we come up here, that market maker move that we have graphed on the chart, this little icon here, that means market maker move, the MMM. And it has a buck. My nose is just not happy today. $1.43 up or down. So many times this that we're buying for this option could be close to that. Now, if we were doing the ones that expire this week, it would be closer, okay, to that 143. But we're buying an extra week's worth of time so that we have a little bit more time to see maybe what the trade might do, see if it needs a few more days to move in a direction we might want it to move, and to not be paying so much like we might if we were buying that first week. All right. Wax says, Levi recently beat expectations in that fourth quarter, driven by strong DTC and e-commerce growth. And expectations include an 8% year-over-year revenue growth. All right, you've been drilling into some of those details there, Wacky. Very good. Thanks for sharing that information with us. All right, it's going to be $1.90 for us now. So let's go ahead. Let's get the trade in. And actually, I want to do 2 contracts here. Sometimes it gives us some flexibility of maybe an initial move, we clear out a 1 contract and maybe hold the other contract for maybe an extended move. We don't have to do that, but it gives us the opportunity to do that. Okay, so we're going to do 2 contracts here. Hit confirm and send. We're going to send it down into our straddles and strangles grouping here. We're going to send that, expect to get filled on it in the next little bit here. All right. Any questions on maybe what to look for? What kind of a stock we want to look for? Something with a big announcement, in this case, earnings. It doesn't have to be earnings. We've talked in the past about, if a stock has an FDA approval pending, that can move a stock pretty big, right? Maybe a news of there's a lawsuit, and we hear in advance, hey, the lawsuit decision is going to be determined on X date. Implied volatility could ramp up for something like that. So just be aware, it just doesn't always have to be earnings. We haven't had any good examples recently of some that aren't earnings, but that doesn't mean that they don't exist. All right. Next up, let's take a look at another stock. This stock, given what's going on with oil prices, could move pretty big. Here's Delta Airlines. Now, Delta Airlines, if we look down here at its implied volatility, looks like it really ramped up here during this pullback, which we expect, right? We expect implied volatility to move up when we're concerned about downward movement. Okay, so yeah, it ran up here. And then as it started coming here into earnings, I'm going to say maybe just a little bit of a ramp up here. And it's just kind of staying in an elevated area is what I would say. Sometimes that ramp up comes a couple of weeks or maybe 3 weeks before they even announce earnings. Sometimes we start to see that creep up. We're going to talk about that and use that concept here in just a little bit. So just quickly, does the Delta move pretty big at earnings? We're going to look for gaps. We're going to look for big candles. Now, number 1 here, look at this giant green candle here. I'm going to zoom in so we see that a little bit better. Okay, they announced their earnings before the market opened, and so we got to see the news reaction the very same day. Had a nice big long candle, so it gapped up a little bit from where it closed the day before, but then it ran, and that was a pretty good run. It looks like the range that day was $8.44. You can get that by having your mouse on the candle and then looking up here where it gives us the open, high, close, low, and so forth. Ours for the range, $8.44 on a what started the day at about a $38 stock is pretty major. Okay, so yeah, it really moved big at that time. The next earnings, let's see here. Let's move over a little bit. Nice big gap up. Next earnings, what did it do? This is an interesting one. It gapped clear up here, 60 something, and then it dropped. And then the next day it continued to drop. So even though the initial reaction looked like it was bullish, it didn't last. So sometimes when we're kind of trading out of these trades, sometimes we have to make some pretty quick decisions. If it gaps up, we don't know if it's going to stay there, right? It gapped up to here, and then it fell. It didn't stay there. And so sometimes we may have to make a quick decision. And sometimes after the fact, we can tell, oh, maybe it wasn't the best decision, or it might be, oh, so glad we did that because this is what the stock did after that point. All right. These are the kind of trades you don't want to put on and then go on vacation when you don't have access to the market. And then let's see what this one is here. This one is not quite as big of a move, but it looks like it gapped down then it ran up during the day, and then it fell. So not quite as big of a range. However, with oil prices, with what's going on there, and decent sized moves, we might expect something to happen here. So their announcement is going to be on the 8th. So that's going to be Wednesday morning before the market opens. So Levi and DAL will be looking at on Wednesday morning. Levi will be looking at it the night before because we'll see the announcement, and then they do their conference call the next day. All right. Now, Bessie wanted to see, how do you put in a close to trade to close the trade? I'll show you that. Okay, Bessie. Basically, what we're going to do is we're going to put in a closing order, but we'd want to have some strategy. For example, let's go ahead and decide what we're doing here on Delta, and then I'll put in a closing order with it to give you an example on that one. Now, Delta Airlines, this is actually creeping up a little bit from where it was earlier this morning. Earlier, it was about 4% something. Now it's up to about 5%. It could continue to creep a little bit over the next couple of days. I wouldn't expect it to be extreme, but it could continue to creep up. All right. Implied volatility into the options that expire Friday is 88%, and then it drops down to 73%, and then 63%. Okay, so again, a lot of implied volatility priced into those options that expire. Now, questions come up before, which some of you might have this question as well, is what's the difference between the market maker move here at 356 and say at the end of the options that expire on Friday? It's saying about plus or minus $5.05 right now. Why are they different? Okay, the reason that they're different is the market maker move is just for the earnings event. Okay, it's not to Friday options expiration. Friday options expiration is where there's a $5 move expected. For the actual announcement, it looks like maybe 350. All right, and so that is the difference between those two. Now on this one, we're going to do a straddle again. We're going to do the at the money. This one does give us a little bit more variety of strike prices, which is nice. In terms of GR at the money right now, looks like it's going to be 67. You know, and you could go a little out of the money with the straddle here, and you have a few more choices than what we really had with Levi. Okay, but we're going to go ahead. We're going to do a straddle with this one as well, with the expectation that either the call or the put is going to be a winner. And whichever leg, whatever direction it doesn't go, that's going to be our losing leg. Okay, and so we'll want to try to get out of it as quickly as we can. Let's go ahead. Let's do the same thing here. I'm going to click on the ask price for the put. We're going to hold my control key down. If you're on a Mac, that's going to be your command key rather than control key. So this trade is going to cost us about $6. Now, question here was, well, how do we put in a closing order on that? You could do a number of things. One, you could do a first trigger sequential and then just have one order. You could also do a first triggers OCO right up here if you had something, say, for a target and say something for a loss. In this case, we don't necessarily want to trade out of both of these because we're expecting one to be a winner and one to be a loser. Okay, but if you wanted to put in a closing order, let's do this. Let's go create opposite order. And what if before they announced their earnings, what if we got 30% off of it? Would some of you be satisfied with 30% and say, gee, let's not even hold it through earnings. Let's just go ahead and get out of it. That's a possibility. Somebody might think that. And I'm throwing out 30%. Maybe it's 20%, 25%. Here we've got 595. And so if we wanted to get out, say it got a 25% increase, let's do this. Let's multiply by 1.25. And that would say, okay, go ahead, close it out at 743. So I'll leave 743 on there. I'll do that for a couple of days because if it runs up tomorrow, great. Maybe we get out early. I don't expect that to be the case. That would have to be a pretty decent size ramp up. So again, I wouldn't necessarily expect that. And then I am going to come in here and close this if it doesn't get executed. Okay, but that could be one example if you want to put it on. You could also do this. You could also say, well, if the 67 call, say it gets to be, say, a low value compared to what the initial price is. On this call, it looks like it's going to be about 305. We're going to get the midpoint here, but about 305. So you might say, well, gee, if it gets down to 50%, say $1.50, maybe you want to put it on as a stop on the call leg only. Or same thing on the put. If it gets down to 50% of what the put is worth, in this case, about $1.50-ish as well, then you could set those up as separate orders. Okay, you could set that up as a one triggers other and have the call and have the put. You could work with it that way. Okay, I'll go ahead, I'll put it in for just this. We get 25% right now. And let's go ahead, we're going to send this in to our straddles and strangles grouping. RB Tech Trader said, would it make more sense to use a diagonal instead of a straddle to get better use of the volatility difference? RB Tech, that definitely could be an approach. And what RB is suggesting is that maybe we use the implied volatility that's so high here this first week and be a seller of that. Typically would sell the straddle, the at the money, and then maybe come out here and buy out of the money. That's typically what we'd do, would go buy out of the money to have on some, I'm going to call it a buffer, to have on a hedge lag so that so we're not just sitting naked with a call and a put. Now, we did 2 trades last week where we did that trade, a straddle, strangle, swap, and we're going to go out, look at the results right now. Okay, so you definitely could do that. So this strategy that we're doing right now is called a straddle. We're buying the at the money call, the at the money put. Right now, that means it's the 67 strike price. If we wanted to go out of the money, we could do a long strangle. You know, so we could have come out here and said, oh, let's go buy the 65, a little bit out of the money, and then maybe here the 68, a little bit out of the money if we wanted to do a long strangle. Okay, so great questions, you guys. Now, John's saying, you know, almost a 10% swing either way, but then the Ivy crush might shrink all as well. A question mark, yeah. Implied volatility is going to come in once the news is out. Then that implied volatility really crushes out. And we could see if we looked at it on Levi here on the last earnings announcement, say for Delta. Notice how it was at about this level, and then for the next, looks like maybe the next 2 or 3 days, it dropped. So a lot of it coming that very first day, and then maybe getting a little bit of residual, maybe just looks like the next day. Okay. All right. Should we take a look at, oh, let me see what Cecil's saying here, if this is something I need to address here. Okay. Yeah, Cecil's saying, you know, if you wanted to, you could wait for the stock to really move, let the vol crush come out, and then pick a direction. Which way is it moving? Okay, let's go look at some of the trades we still have. We had a leftover trade on CCL, and then we put on a straddle strangle swap on our trades last week, Nike and PVH. So let's look at Nike first. And I'm going to just zoom in here. We're just going to look at 3 months so we can see the action, what happened, where it stands right now. I will show you Nike right here. The only leg we have left is this 49 put, which is dated to expire this Friday. We did a straddle strangle swap, so we sold the straddle for the options that expired last week, and then we had a long put. We had a long call out of the money. That was our long strangle. And this is the remaining leg. And now, what we need to be aware is when it shows this P&L profit here, it's for what the value is right now of whatever legs are remaining. Okay. It's not taking into account what's already happened. Oh, good. There our Levi just filled. Okay, so you have to know that. So one thing I did here before our class started, I said, well, let me go plug in the values that we already know about. Okay, so let's start here. Here, let me hide these guys so they're not so distracting. Let's just hide them for a minute. So on Nike, we did a straddle strangle swap. That's what my SSS stands for. And we don't need this site so much here. Let's go to our account statement, and we've got our Nike, and let's fill in our spreadsheet. So here we have our 52 call, our 52 put. These were the short legs. I should maybe move this over there so you can see these are the short legs. We got a credit of 217 and a credit of 221. So I've just plugged that into the spreadsheet here. And then we had a 49 put, we paid $1.14, and a 55 call, we paid $1.28. We put it in all together, and that gave us a net credit of 196. Now, because you have 4 legs, it's kind of helpful if you track what you're getting out of each of them, so you know, for example, our remaining put, what do we need out of it to even break even? What do we need to make money? Okay, so let's go under the close column. Let's go put in on the 52 put. That was the first one that we got rid of. And I want you to see the times on that. So at 7:32, right after the direction was a given, because it dropped, right? We had a huge drop here. Let's go back. We went ahead, we made a decision. We said, we've got to buy back that 52 short put because it's going way against us. A short put would typically be bullish. So implied volatility came crushing out. But because of that movement, that short put was really quite a bit underwater. Okay, so that put it at 595. So let's go plug in 5.95. I'm going to do it as a positive because it was money going out. Next up, what do we do next? Next, about a minute after that, we said, okay, it looks like the call is not the winning side. This longer dated call, let's salvage what we can. We could only salvage 6 cents out of it. Okay, so I'm going to put this one at, we got 6 cents out of it. Make sure I didn't skip one here. Then at 7:36, so all of these happened right after the announcement. On the 52 call, that's the one we made most of our money on so far. We brought in 221. We said, let's go close that out. We can go buy it back for 2 cents. Sweet, let's do it, be done with it. We could, if we wanted, held on to it and said, we're just let it expire worthless. And it may have or it may not have, right? We've seen things reverse on us. So we said, we're going to do the sure thing where we go close it up and be done with it. Okay, so that was on the 52 call. Oh, I filled this in wrong, didn't I? Let's see, that was on, did I fill this in wrong? I did. I put the, let me put the right amount here. This is going to be 0.02. And this is the one that's going to be 0.06. Okay, so we just have the 149 put left. So I made this little spreadsheet, and basically this just sums everything up, and this one just summed everything up, okay? What do we need to break even here? Looking like about 591. So that gives us the opportunity to come back to our trade. Let's go to the account position here. And what do we have here? Well, it's at 522. So it actually has made a little bit more progress today. but it's still not up to our break-even amount. Okay, so we are going to give Nike a chance to fall a little bit more, see if we can get out at a little bit better exit point. If we were to go and get out right now, we'd be locking in a loss. There's no guarantee it's going to continue to drop, but it is down a little bit today. It would be nice if maybe it pulled down a little bit more tomorrow. Maybe we're able to exit. Okay, so when you do the straddle strangle swap, there is a lot that you have to take into consideration. There's 4 legs to watch. You've got to make a independent decision on each of those legs. Is it serving me right now or not? Which ones do we need to get rid of? Get rid of those first to either buy it back really cheap or to, on the one that's going against us, in this case, it was the short put, to go and buy it back as quickly as we can so that that deficit doesn't become bigger, okay, that we go and buy it back for. All right, let me see if we have more questions we need to address. Very good, very good. Looks like we've talked about everything here. All right, real quickly, we won't do all the math with the spreadsheet, but that might be something that helps you, okay? Let's close up Nike. We had PVH. We're in a kind of a similar spot there. We did a straddle strangle swap. The only leg that we have left is this 75 call, and we need it to run. Calculating this morning what we needed for it. Let's see if I wrote that down. Oh, I might not have written it down. Oh, I did. It needs, we need to gain about 87 more cents from what it's pricing out right here in order to get to our break even. How did I get there? I went in on my little spreadsheet. I just filled in everything. This is the numbers we know when we got into the trade last week. Here's where the numbers sit right now, or when we exited that leg. Okay. CCL is one that, let's just quickly look. PVH is continuing to go up, so we're hoping it will continue to run a little bit more. We've got the long haul left here. Okay, so we have a few more days, and it's moving nicely for us. Great. CCL, this was from 2 weeks ago. CCL, what we have, let's see what we have left on it. We just have the put left. It's dated out here April 17th, so we actually have about 11 days for it. Okay, so next Friday, is it doing what we need it to do? Well, we really want it to ramp up. It's not. Okay, we do have a little bit more time. I would love to see this ramp up. Right now, it's kind of just gone sideways. It didn't really move that big over their earnings. They announced here before the market opened, so it moved from here to here and then dropped a little. So not nearly as big of a gap as what we were hoping for. Okay, so yeah, let's go ahead. Let's see if we can get it to increase in value. Right now, that puts at 25 cents. If it starts to ramp up, we might just have to go close it. And if the stock price, I should say, ramps up, and therefore our put value continues to drop, then we'll probably just close it out and try to salvage what we can out of it. Okay. All right. That's been quite a bit for us to go through here today. You guys have been great. You've had some really good questions. So if you want to paper trade these 2 example trades with the class or class example trades, do so. Okay, that's going to be Levi and Delta Airlines. Okay. We'll watch and see what the reaction is that night. We'll look and see pre-market in the morning if it still looks like it's moving the way it did, say, on Delta the night before. It looks like it's, is it Delta? Maybe it was Levi that has a day. Yeah, Levi announces at night and then they have their conference call in the morning. We'll want to check both of those and just see. It's not guaranteed to be the same place in the morning as it is, say, for the nightly session that we watch how the market reacts. All right. I do hope all of you are subscribers to our Trader Talks channel. When you are, it makes it so much easier for you to find our content. So go down your bottom right-hand corner. You can hit that little subscribe button. That'll allow you to see our content, see what Ben is teaching. And you can go and follow playlists of the different classes. So it just makes it pretty handy for you to find our content. in our playlists. All right. I did not see a survey out there today. If this was helpful to you and you think others might benefit from viewing it, go ahead, hit the like button on the way out the door, and follow Ben and I on X, Ben Watson CS, Connie Hill CS. It'll give you some content to think about, maybe give you some ideas as we look at different things going on in the market. Ben, thank you for helping me out today. These guys weren't too difficult on you, which you probably appreciated. All right, next week we'll follow up on these moves. Now, coming up next, right at the top of the hour, is going to be Barbara Armstrong with Trading a Smaller Account. I know lots of you love that class, so meet you back here for that class in about 15 minutes. We'll follow up on these next week. Bye-bye.